Who wants to kick off? What is impact investing? What is your definition of impact investing? What do you look for?
My definition of impact investment would be to make a difference in people's life, be disruptive, provide solutions that is not available currently.
Could you use the mic a little closer?
Yeah. Can you hear me now? My definition of the impact investment is to make a change in people's life, change the status quo. I always believed in the Gandhian principle. If you want to make a change, be the change. So the question about is how do we transform lives of people for a better living, better conditions. So our focus is at the bottom of the pyramid, which is a huge population of 4 billion people. So every technology that has been advanced so far has only addressed the top layer of the society. The bottom layer has always been ignored. So that is to me what we are trying to do.
Ashok, from Unreasonable, what is your main driver? What would you call the drivers for impact investing?
I think they're very similar to what Arun mentioned, and really trying to find the products and services that reach that bottom of the pyramid. For us, it's both because that population has been traditionally underserved, and now as their incomes are rising, they're looking for more products and services. And if we can find local companies to provide those, that's going to improve the quality of life of significant numbers of people, billions of people, and also provide our investors with an attractive return and show other people that this is actually a really exciting investment opportunity. So for us to invest, it has to pass an impact screen for us to even open the book. And then after that, we're really looking to confirm that there's an attractive business model that we think can grow long term.
Mm-hmm. Could you give your definition of what it means to you, impact investing?
Yeah, I think it's going to get boring now because I probably will repeat more of the same. But I think for us it's about providing people the opportunity to develop themselves. If you and we're really looking at developing markets, frontier markets, at places where people lack essential services and products, which we take for granted, and we have it. And we have it actually either for free or for a very low price. They don't have it or have it at a very, very high price or at very bad quality. And this is really where we focus our activities on.
And how would you define like the main difference between impact investing and regular VC investing? Is there a difference?
The problem
is it changing, getting closer?
The problem is that impact investing has no definition. I mean, each of us has a different definition. When you look at how I think most of us here on the panel are seeing impact investing, I think it's about going where traditional investors don't go yet because they perceive these markets as too risky. So maybe we take additional risk.
So it's real venture capital.
It's
sense,
definitely
right?
venture,
Some people
but it's
say
not
venture
technology.
Capital today is more like banking, so
it's not technology
risk
like typical venture capital is taking it. It's more like market risk. We go at low income markets, which are perceived as being very, very risky. We believe that there's less of a risk than most people think there is, but yes, that's probably the main difference.
Mm-hmm. Could you dive in like the difference between traditional VC investing?
I don't think there's necessarily a change in, a difference in potential returns. Maybe a bit more risk because it's a market that's underserved or less accepted by other VCs. But there is a really main basic difference. We only invest if it really brings change and good change. And that means that our scope is a lot narrower than a regular VC.
Would you say that since like big issues that need to be solved, let's say in food, health and energy, in those areas, those are biggest growth markets anyway, so do you think you're more patient to see results in terms of investing?
You have to be a bit more patient, and you also have to be more strategic. And we are trying to show that you can have truly healthy, sustainable, and affordable aquaculture, fish farming, plants, seaweed, etc., at financial returns that are at least the same as traditional industry, and then hopefully traditional industry will follow. That requires a really, well, a laser focus on what you do, and then making sure that you actually get those results, because otherwise you're breaking more than you're fixing.
And are you looking at each investment as a single investment, or are you trying to create like this added value in the group of the portfolio?
We invest across the value chain, so we are definitely looking at synergies between those companies. So we invest in a feed company or a feed ingredients company and say, well, okay, we want the investment, and we think that this can bring real change, but at the same time we want that company to supply to all the farming investments, and then make sure that these farms can actually get those products at the same prices as the biggest clients of the feed ingredient company, so they can actually replace an unsustainable feed ingredient, become more sustainable, and make more money. Instead of saying, well, right now you have less than a handful sustainable farms on the planet. You can still debate if they are actually sustainable. But the fish that comes out of those farms is 4 to 5 times more expensive than regular fish. That only works in San Francisco, London, and Amsterdam, and it's not going to change the world. And I don't want to take away from people's life's work, but what we are trying to do is show that you can actually, we want to change the whole global sector, and that's not going to work if it's going to be much more expensive. So by necessity, we have to look across the value chain to build synergies, because one-offs is going to be way too difficult.
One of the things that we heard in the previous discussion was that community can be a great driver for scaling up impact companies. Ashok, is that something that you're seeing? Unreasonable Institute is pretty powerful in its community message. How can you elaborate on that?
Absolutely. We've worked with over 200 companies over the 6 years that the accelerator programs have been in existence. And as much as we like to talk about the mentors that come to our programs and help the businesses think about building their management team, improving boards of directors, about how to scale their business model long term, in a lot of ways, probably the more important dynamic are the relationships they build with each other. That companies within Kenya talking to each other, not only during our multi-week programs, but then connecting with each other every month afterwards, talking about what's happening in their local markets. Also, across geographies as well, we held a program a few years ago with a solar company that was based in Tanzania and another solar company that was based in India. And while at first blush they seemed like competitors, it turned out that the products were actually very complementary. So they ended up forming a joint venture at the end of that 2-week program where they would start selling each other's products. One was better to light individual desks, and the other was better to light in the whole home. So I think the communities that come out of not only accelerator programs, but things that the Doen Foundation might be able to put together tend to have multiplier effects.
What about data as a driver for like insights and transparency in what you're actually building? How important is that?
The data that we track with the companies? Absolutely. So just understanding dynamics within populations. We, for example, those 2 solar companies, one worked with a lower income population, the other worked with more middle class, and for them to be sharing data across those segments, and it's a little different because it was different markets, but there's a lot of similar behavior patterns for people living on less than €1 to €2 per day. And for the younger company, they really benefited by understanding as the population started to earn more money, how that would affect the behavior in terms of product acquisition. So we were able to facilitate that, and I think the companies really worked together, and they both benefited from that exchange.
Would you say, Arun, that for a mixed environment of investors in a company, how do you relate to the, let's say, regular VCs if you're both investing in a company and with you more driven by purpose and impact than the other investors? How is that dynamic in a company like that or in the board meetings? And please use the mic.
It's kind of funny the way the whole impact space has now moved. We have also seen a lot of mainstream VCs getting into the space, which is kind of interesting concept. So
what type of VCs?
The mainstream
VCs,
like it could be one of those big guys from Silicon Valley, now have gone into the markets and developing markets. And I always get asked the question, is Walmart a social impact? It provides products to people that others wouldn't have had it. So how do you define impact? How do you define impact investment or a social impact? A lot of these major venture capital firms look at these developing countries and look at the market that's coming up. What has happened recently is the technology has leveled the playing field. Technology has made a massive change in the consumer behavior. Telephone, for example, mobile communications. In India, I think when I was growing up, in about 40 households, 3 households had phones. Today, the same 40 household, if you add all the kids and the maids working in their home, they probably have 5 phones per home. So this change in technology has made a massive difference, where the larger VC firms have started looking at these countries as a potential opportunity to invest.
Yes.
Bring the technology to bear. So you run into sitting with the VCs and having the communication and going through the part.
Would you see that you feel the heat of like the mainstream big VCs moving into the space that you have owned for the last 25 years? What is changing in that?
Well, the VCs, maybe they go to companies where there isn't any trade-off between impact and financial return. So, for example, for Bcash or for Mcopa, these are really our growth models where you can achieve impact and you have financial return. So it's more busy over there, but there still are a lot of companies where there is a trade-off between impact and returns. So, and I don't see them over there because...
And the alternatives for the companies that traditionally come to the Doen Foundation, are they seeing more alternatives in the Netherlands or do they have to go abroad too?
I think more and more people are into the impact space.
Yes.
You see, for example...
How many countries are you investing in?
Sorry?
How many countries are you investing in?
I don't know. I think...
5 continents. Let's keep it like that.
Yeah?
Yeah.
Well,
All right.
I have no idea, but that's quite a lot. But you see in the impact space that family offices, for example, who have a traditional charity arm, they are more and more interested into investing into an impact kind of companies. So it's getting more and more busy, which is good. It's good for us. We like to collaborate. And what you also see is that there's more and more into growth capital. So the very early stage companies, they still are looking a lot for investors.
Is it harder, has it been harder to do your own fundraising for your own funds to start investing? Has it been harder in the past? Is it easier right now, or is the competition driving scarcity in that? Yes.
Looks like I'm answering this question. So I think fundraising is becoming harder than it in the impact world than it was a couple of years ago, because people are now starting to ask, okay, we at least on the more institutional side, we gave you a leap of faith. Now we want to see the returns, and they wait. It depends on the sector, for the sector track record to really put in larger tickets of money. So if you want to raise money from institutional investors, it works in financial inclusion. So in microfinance, for example, because there's a sector track record. It still doesn't really work in energy or in other access to energy or other areas, because we still don't have that big exit that shows to more mainstream investors that it actually works. Another issue that we're facing today is that the markets are becoming so volatile that people, especially when it comes to equity investments or equity fund, 10 years closed-ended funds, they don't like the fact that they're giving away their money for 10 years. They want liquidity. because they want to be able to shift their money quickly if there are
Right.
some issues in their portfolio, because the world has changed in 2 years. So I think these are two things we're struggling with, and of course it depends on the sector. So in microfinance, it's much easier to raise money, but in access to energy, it's actually a challenge.
Would you say, Mike, that the companies that you're investing in have a better clue of what they ask for and how to spend it on and on valuation? Have the companies start to get more intelligence on how to play this game?
Increasingly so, but they still have a long way to go. The aquaculture industry is relatively young. It only started basically in the 1970s, and a lot of companies, a lot of farmers don't really have a lot of financial jobs. So
They are more tech savvy, I guess, but yeah.
yeah, but that doesn't necessarily always mean that they know exactly how to value things and what to ask for. But it's getting more and more professional, and you see better propositions every single day.
Yes.
And we have a slightly different experience with fundraising at the moment. But
Could you use the mic? Yeah.
Sorry, yeah.
Yeah.
But it's more, we have high net worth individuals and family offices, and we are actually seeing that it's picking up and easier, but it's not institutional.
It's a closed-ended product for
open-ended.
That's the big difference. It's really a big difference. So if you provide liquidity or have an open-ended structure, it's easier than if you have these closed-ended private equity funds. But I guess it depends on so many details. So, but yes, overall impact investing is becoming more interesting, definitely. Well, we still don't see that much money flowing into impact investing today. It's still without a Doen or these type of organizations, it would be very hard to fundraise.
Especially at the start, yeah.
Early stage. High risk, early stage, small amounts. Ashok, how could you, what could you tell us about how you see the future of this business of impact investing evolving? Crowded space, more money available, more people, but also more companies to invest in. How do you look at the future?
Sure. And I'll caveat it with that we just closed our first fund, so limited scope in terms of how the space has, how fundraising has changed over the last 5 or 7 years. What I see happening in terms of the parties that we've spoke to over the last 24 months of our fundraising is that there's increasing interest in what's happening. It's almost like there's a concert or some event happening behind a big fence, and a lot of people know something is happening, but they're not quite sure what it is. And so they're all staying behind the fence for the time being, waiting for there to be those exits. And Arun has, thankfully with Grey Ghost, you've had some great exits, and I think that's making it easier on the rest of us.
Yeah.
But with that said, we need more exits for people to feel comfortable deploying their capital. We have had a lot of meetings with more traditional public pension funds, university endowments. I was on the phone with a major U.S. group that represents $25 billion of capital on Friday. They reached out to us and wanting to learn more. And now they claim that their biggest problem with this space right now is that they want to write checks of 50 million or more. And that's a little bit more challenging to deploy for a lot of the impact funds, since we often, to support the enterprises in developing markets, they're not looking to raise a $20 million round for the most part. So there's a little bit of a gap there. As far as the space, as it grows and develops and as it relates to venture players, I think impact investing, as you know, the sort of weighted average of all of our definitions, I think it will fade away over a 10 or 20 year period, and it will turn more and more into more traditional venture investing. I think people will understand the populations in these markets and their desire for products and services. And we're already seeing venture capital firms invest in some of the companies we invested in. We came in at an earlier stage while we were proving the concept and generating a meaningful amount of revenue. Now that's happened, we have more venture players coming in once a company generates $500,000 or $1 million of revenue. So I think the venture players will continue to take more and more space, they'll take more and more interest. and that'll probably free up more and more capital for all of us to raise. We may change the terminology on our web pages.
Exactly, the terminology would it be like, when will we stop using the term impact investing, and will it be there's no such thing as non-impact investing, I guess, in the future? Yeah.
That's my opinion on it.
Christian, you want to comment on that?
I would like to add something. I very much agree. So if you look at the microfinance sector, I'm coming back to microfinance because that's the poster child of impact investing, right?
Yep.
It started, the microfinance idea was built with non-profit money. It was all NGOs behind actually almost any microfinance institution, which today is a bank. Mm-hmm. Then slowly MIVs, like impact investment vehicles, came into it, helped building a track record, mainly on the debt side first, then on the equity side. And now it's a pension fund thing, right? It's becoming really mainstream. So I think what impact investing, in my definition, somehow is doing, is we're building these markets. We're helping creating that or building that track record to actually bring in the big amount of money. We want to make it mainstream as much as possible. But I think what actually will happen is either we go down and we don't exist anymore, or we go up in terms of ticket size, we become a mainstream private equity firm, or we move the needle towards the more needed and the new problems and the new issues where the mainstream money is not going. And I think that's what we want to do.
So, Arun, you said be the change you want to see in the world. Is it, if you do your work at best, is like every investor would be doing the same thing in a couple of years, I guess?
Yeah, I think so. Yeah. But the question of innovation, right? It's always going to be new products coming out there, new ways of doing things. So the way we believe is, just to answer a little bit of questions they're talking about is, impact space is still in infancy. It's still been a domain of foundations and high net worth individuals, some pension funds out there are doing it, but it hasn't really caught up, as they were talking about earlier. The thing is to raise it to the next level. Mm-hmm. How do you bring in the financial institutions into it? Mm-hmm. And what would they do? And
are we on that verge right now?
Absolutely. Mm-hmm. Yeah, and that is what we're trying to create, actually. At least in Greygo's standpoint, it is more than us. We don't look at us as what do we do next in Greygo's, but what do we do to improve the impact space as a whole? Mm-hmm. How do we bring it up to the next level? Yeah. And for that, you have to have proof points. Yep. When you have commercial guys coming in, they want to see you're able to scale companies in impact space. That has been one of the biggest problems. Mm-hmm. There's not very many companies out there that are scaled enough to get the attention and the interest of the true financial institutions out there. Yeah. So I think that is, to me, I think is one of the primary factor. There's a lot of confusion what we do because of the different segments within the impact space. DFI looks at it differently. Foundation looks at it differently. Family offices look at it differently. So the different constituents right now that are kind of a part of it. When in commercial world, it's all just somebody wants to make money. There's one bottom line. Right. But in impact space, it's not the case. So I think as long as we provide clarity, we're able to provide proof of concept, and this thing is workable, I think that will bring in more people from the mainstream VC world. And assuming that they come in, it's good, actually. It's kind of to me, it doesn't have, it's a very gray line between social good and economic good. Right. The way we perceive it is all the companies should have a social DNA. If there's no social DNA, we don't invest. But at the end of the day, the company has to scale, has to grow, has to be scalable. Yeah. And all the stuff is very important for us as we go into our philosophy of investments. Which is, I see a lot VC firms very much close to that. I mean, they're not too different from it. The question really comes down to where the interest lies. How do you pick a company? And that, I think, is a big difference between impact space and a VC world.
So who has the finest hand in picking the right investment? So the last question for you to think about is, who are the heroes in your field, the people that we should be watching out for after you will explain us the next 25 years of impact investing Doen style? Can you look ahead and share with us and the public what that looks like, if you can grasp it?
Well, let me first start to mention a couple of heroes. For me, I think if it's about scaling, then there are a few scalable business models we've seen today, and we are very proud of that we are part of it. But one of them is Mcopa, for example. It's a pay-as-you-go solar solution, so people can just, for a little bit of money, get their own solar system, and they pay back with their mobile phone. This is something which is really getting big in Africa. But there are also other examples which are less scalable but really inspiring. So close to here you have a brewery, De Praal. I don't know if you know it.
Yes, we know them. Yeah.
Okay,
well,
and about 120 people work there with a psychiatric background. And these guys are brewing beer, but the main goal is to have as much of those people in their company. And these are examples I would like to see.
In terms of investing, who has the best hand in picking the right startups? So the investor heroes in other places, yeah.
Well, I think I'll go for Arun then.
So your neighbors, right? Yeah.
Yeah, we do handpick, no doubt about it. You're talking about picking companies.
Yeah. So who are the investors that you are looking at having the best hand in picking the best investments? So apart from the people next to you, sitting next to you, who out there is doing that?
There has to be a synergy. When you're sitting in a board, it's important to realize, and I tell that to all the entrepreneurs too, don't take the first money walking into your door. Right? I mean, you live with this guy for the next 10, 12 years on the board and try to work with them, and it's your life, because entrepreneurship is not easy. You're giving everything that you have. So you need to ensure that you're around people that are same wavelength that you are. So I think it's important. It applies to me, it applies to the entrepreneur, who you're sitting with, and what kind of a board you're trying to create. Investment is it's not like you do 2 years and walk away, things don't work out, especially in impact space. You have to hang in there. It's a little slow process.
Long-term relationship.
It takes about 7 to 9 years for a company to what I call a classical J curve. As soon as before they come out of the x-axis, it's about anywhere between 5 to 7 years. I used to think it is 3 years, but it was a hard lesson for me. It takes about 5 to 7 years for a company to come up.
Yep.
So you're living with this person whether you like it or not. Early companies have monthly or every other month a board meeting, and you want to make sure everybody is sitting around you in the same path that you're following. So absolutely, I handpick everybody. And also, it depends on what kind of technology. What do you bring to the table? It is just not the money. Yeah. And it's very important for that, because a lot of people think we all put money and just sit there and wait for the reports to come. We are constantly engaged with these companies. The value that we bring is other than money. So what kind of investors can bring what kind of value when they're sitting up there is very important.
All right, thank you. Time's up. So 2 more names, people that we should be looking out for. What are your inspiration, your role models when it comes to investing and picking the right startups? Okay, Mike? No? Okay.
I would highlight actually Gregos and Bamboo as people that we've learned a tremendous amount from. But for the sake of giving you another answer, I had to highlight Endeavor Capital, which has a very innovative model, building local communities of investors that are supporting people within their local geographies, and they have a different profit-taking structure as well, but effectively they operate almost as a not-for-profit. The profits get reinvested into new businesses in their space. But just very quickly, I want to add that for me, the real heroes, no question, are the entrepreneurs, the local entrepreneurs that are building the businesses, understanding what their markets need, putting in the time and effort to navigate a much more challenging environment. It's a luxury for me to get to work with them.
Yeah, that is the best way to end this. Thank you very much. Thanks for your attention.